In our previous discussions, we explored the world of fundamental analysis. We learned that it is the essential first step for any serious investor. It helps you understand a company's financial health and its intrinsic value. You learned how to review balance sheets and income statements. We even demonstrated an automated tool that simplifies this entire process for you. Mastering these fundamentals is like building a strong foundation for a house. It gives you the confidence to know why a particular stock is a worthwhile investment. It is the bedrock upon which all successful trading strategies are built. Without this step, you are simply guessing. Now that you have a solid grasp of fundamental analysis, it is time to take the next step. You have identified a good company, but a crucial question remains. When is the right time to buy its stock? This is where technical analysis comes into play. It is the second key skill every trader needs to develop. If fundamental analysis tells you which car to buy, technical analysis tells you the right moment to press the accelerator. It focuses not on the company's value, but on the market's activity surrounding its stock. It is a different lens through which we can view potential opportunities in the market. Think of it this way. A meteorologist studies fundamental data like atmospheric pressure and humidity to predict the weather. This is similar to a fundamental analyst studying a company's financial health. However, the meteorologist also looks at weather charts and satellite images to see how weather patterns are moving right now. This is what a technical analyst does. They study stock charts to understand the current market sentiment and predict future price movements. It's about observing the actual behavior of buyers and sellers in the marketplace, providing you with a dynamic view of supply and demand in action. Therefore, after you have done your homework and found a fundamentally strong company, you should turn to technical analysis. It is the skill that helps you time your entry and exit points with greater precision. It is not a replacement for fundamental analysis, but rather a powerful partner to it. By combining both approaches, you equip yourself with a comprehensive toolkit for navigating the stock market. You will know what to buy and have a much better idea of when to buy it. This dual approach provides a more complete picture, increasing your chances of making profitable trades. So, what exactly is technical analysis? In simple terms, it is the study of past market data, primarily price and volume, to forecast future price movements. Technical analysts believe that all the information about a company, including its fundamentals and market psychology, is already reflected in its stock price. Therefore, by analyzing the history of a stock's price, we can identify patterns and trends. These patterns, they believe, have a tendency to repeat themselves. It is like learning to read a map of the market, where past routes can give clues about the likely path ahead. Imagine you are watching a river. You can see the speed of the current, the ripples on the surface, and the direction the water is flowing. By observing these things, you can make a good guess about where the river will go next. A stock chart is very similar. The price movements are like the river's current. The volume of trading is like the amount of water in the river. A technical analyst studies these elements to understand the force and direction of the market's momentum. They are not concerned with why the river is flowing in a certain direction, only that it is and where it is likely headed. The core tool for a technical analyst is the chart. Charts are visual representations of a stock's price action over a specific period. There are various types of charts, such as line charts, bar charts, and candlestick charts. Each provides a different level of detail about the price movements within a given time frame. For beginners, a simple line chart that connects the closing prices over time is a great place to start. It clearly shows the general trend of a stock. Is the price generally moving up, down, or sideways? This simple observation is the very first step in technical analysis. This practice is not new. It has been used for centuries, long before computers made charting easy. Merchants in 18th century Japan used candlestick charts to track the price of rice. They realized that the emotional psychology of buyers and sellers created recognizable patterns in price movements. This historical foundation is important. It shows that technical analysis is based on the study of human behavior, which tends to be consistent over time. Greed and fear have always been powerful drivers in the market. and their effects are visually captured on a price chart for all to see. Technical analysis is built upon three core principles, or pillars. Understanding these ideas is essential to using it effectively. The first and most important pillar is that the market discounts everything. This means that any factor that could possibly affect a stock's price, be it fundamental, political, psychological, or otherwise, is already factored into the stock's current market price. Therefore, all you need to do is study the price action itself. You don't need to separately analyze earnings reports or news headlines, because the market's reaction to them is already visible on the chart. The second pillar is that prices move in trends. This is a central concept for the technical approach. A stock's price does not move randomly. Instead, it tends to move in a particular direction for a period of time. This direction is called a trend. A trend can be an uptrend, which is a series of higher highs and higher lows, a downtrend, which is lower highs and lower lows, or a sideways trend, also known as a trading range. The primary goal of a technical analyst is to identify the current trend at an early stage and trade in the direction of that trend. The old saying, "The trend is your friend," comes directly from this principle. The third and final pillar is that history tends to repeat itself. Much of technical analysis is focused on identifying chart patterns that have occurred in the past. The belief is that these patterns will produce similar outcomes in the future. This is because these patterns are rooted in market psychology. Human emotions like fear and excitement tend to manifest in predictable ways. For example, a pattern known as a double top might signal that an uptrend is losing steam, because historically, it has often preceded a price decline. By recognizing these historical patterns, traders try to predict what might happen next. These three pillars work together to form the logical foundation of technical analysis. They propose that markets are not chaotic, but have a structure that can be understood through charts. By accepting that the price reflects all known information, that prices move in identifiable trends, and that past patterns can offer clues about the future, you can begin to make trading decisions based on evidence from the chart itself. This framework provides a disciplined way to approach the market, helping to remove emotion and guesswork from your trading decisions. It provides a roadmap for interpreting the story that the market is telling. To put these principles into practice, technical analysts use a variety of tools and indicators. These tools help them identify trends, measure momentum, and spot potential reversal points. One of the most basic and honestly powerful tools is the moving average. A moving average smooths out price data to create a single flowing line, making it so much easier to see the underlying trend. For example, a 50-day moving average shows the average closing price over the last 50 days. If the current price is above this line, it generally indicates an uptrend. If it's below, it suggests a downtrend. Another fundamental tool involves drawing support and resistance levels. Support is a price level where a downtrend can be expected to pause due to a concentration of demand. Think of it as a floor that the price has difficulty breaking through. Resistance is the opposite. It's a price level where an uptrend might pause or reverse due to a concentration of supply. It acts like a ceiling. Identifying these levels can help a trader decide on entry and exit points. Buying near a strong support level or selling near a resistance level is a common strategy used by many traders. Beyond these basics, there are indicators that measure the momentum or speed of price changes. One popular momentum indicator is the Relative Strength Index, or RSI. The RSI measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock. It is displayed as an oscillator, a line graph that moves between two extremes, typically 0 and 100. A reading above 70 is often considered overbought, suggesting the stock may be due for a pullback. A reading below 30 is considered oversold, suggesting it may be due for a rebound. Finally, traders pay close attention to trading volume. Volume represents the number of shares traded during a particular period. It's a crucial secondary indicator that helps confirm a trend or a chart pattern. For example, if a stock's price is breaking out to a new high, You would want to see a high volume of trading to confirm that the move is strong and has conviction behind it. A price move on low volume is often viewed with suspicion and is more likely to fail. Volume tells you how much participation there is in a move, adding another layer of confirmation to your analysis. You have now walked through the core concepts of technical analysis. We've established its role as the next step after fundamental analysis. We've defined it as the study of price and volume, and we've covered its three foundational pillars. We even looked at some of the basic tools like moving averages, support and resistance, RSI and volume. This knowledge gives you a powerful new perspective on the markets. It empowers you to not only identify good companies, but also to time your trades more effectively, moving from the why to the when of investing. Just as we demonstrated with fundamental analysis, the world of technology offers powerful tools to simplify and speed up technical analysis. Manually drawing trend lines and calculating indicators on charts can be time-consuming. It also requires a significant amount of practice to do it well. Automated technical analysis tools can scan thousands of stocks in seconds. They can automatically identify patterns, calculate dozens of indicators, and alert you to potential trading opportunities based on criteria that you set. This allows you to focus more on strategy and decision-making, rather than on manual chart work. In our upcoming content, we will provide a detailed demonstration of just such a tool. We will guide you step by step through an automated technical analysis platform. You will see firsthand how you can set up scans for stocks that are in a strong uptrend. We will show you how to receive automatic alerts when a stock approaches a key support level or when its RSI indicates an oversold condition. This will bring all the concepts we have discussed today to life, showing you how to apply them efficiently in a real-world trading environment. It is the next logical step on your journey. We are committed to providing you with the knowledge and tools to become a more confident and successful trader. Your support makes this possible. If you have found this introduction to technical analysis helpful, please take a moment to like this content and share it with others who might benefit. Make sure you are subscribed and have notifications turned on so you do not miss our next installment featuring the automated tool demo. Your engagement helps us grow and continue to produce valuable educational material. Stay tuned, as the most practical part of your trading education is just around the